Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister, you'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, an IROC dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss how you can combat clawbacks on your government benefits and 10 strategies to mitigate or eliminate this 15% added tax. Specifically, we're going to discuss what is old age security and how much could you receive, what does an OAS clawback look like in practice, ways to mitigate the impact of unusually high income years, 10 tips to mitigate or eliminate an OAS clawback, and lastly, as always, a few action items for you to consider. Well, before I get into today's episode, I have some very exciting news to share. My wife and I are expecting our second child in May of next year. We're so very excited to welcome another little one into this world and are looking forward to many more sleepless nights ahead. So today we're going to unpack how you can maximize government benefits and avoid a clawback of your old age security pension. Specifically, I will be focusing on the old age security recovery tax, sometimes referred to as the OAS clawback. The OAS benefit is income tested, meaning that the amount of taxable income you report on your tax return will have a material impact on how much you will receive and how much you could lose. For starters, the old age security pension is a monthly benefit you can get if you are 65 years of age and older. You are not required to contribute to the OAS pension plan. However, the amount you receive is dependent on how long you've lived in Canada. If you've lived in Canada for less than 40 years after age 18, the amount you receive will be reduced proportionately. So for example, if you're age 65 and you start the OAS benefit and you've only lived in Canada for 20 years after age 18, you will only receive half of the OAS pension. In 2023, this amount is approximately $770 a month or nearly $8,500 a year. If you're older than 75, this benefit is increased to $778 a month or just over $9,300 a year. You can also choose to delay the OAS benefit past age 65 to age 70. For each month you delay OAS, the pension will increase by 0.6%. This equals out to a 7.2% annual increase and a total 36% permanent increase if you wait until age 70. Alright, so with that crash course out of the way, let's discuss how you can possibly lose some or all of this benefit and how you can fight back against the clawback. So as I mentioned before, the OAS benefit is income tested. This means that you can lose some or all of the benefit when your taxable income reaches a certain threshold. For the 2023 income year, the threshold begins at $86,912, with a full loss of the OAS benefit at $142,428 in taxable income. There is another upper limit threshold for Canadians 75 or older, which is slightly higher. Now, just a quick note, the line on the tax return that impacts these benefits is line 23400. This is known as your net income before adjustments. This is especially important for those of you who think they can offset capital gains with capital losses to mitigate OAS clawback. More on that later, but spoiler alert, it doesn't work. Okay, so what does the clawback look like? So in English, what this means is that for every dollar of taxable income you report over the lower threshold of $86,912, you are slapped with an effective 15% increase in tax. So if you reported, say, an extra $5,000 in taxable income over this threshold, this would result in a $750 loss in benefit. So if you reported, say, an extra $5,000 in taxable income over this threshold, this would result in a $750 loss in benefit. This would be seen as a social benefit repayment when you file your taxes and a reduction in your monthly OAS benefit starting in July of the same year. So let's walk through that again. You file your taxes in April, and at that time, learn your income is $5,000 over the threshold. This will trigger a social benefit repayment of $750 that reduces your refund or increases your balance owing by increasing the calculation of total tax payable. In July of that same year, your OAS pension will now be adjusted downward, or in other words, clawed back. So on a monthly basis, the OAS pension would be reduced by $62.50, or 1/12 of the overall $750. This would span from July through June to the following year. Now let's assume that increase in income you experienced in a given year was a one-off scenario. Maybe you sold a piece of land or property, maybe you had a large capital gain in an investment account, or distributions from a holding company, some other sort of infrequent taxable event. In this scenario, the social benefit repayment is still required at filing because on the income you earned in that year put you over the threshold. If you do nothing, public pensions will assume the same thing will happen again next year, meaning your OAS will be clawed back proportionally during the next cycle starting July. When you file your taxes the next year, the government learns your income is now below the threshold. Now you will receive a credit on your tax return dollar for dollar and increase your overall tax refund. Alternatively, if you didn't want to wait a full year to receive the credit on your next year's tax return, you do have the option to file a form with CRA called the T1213 OAS, Request to Reduce Old Age Security Recovery Tax at Source. This form provides CRA an estimate of your incomes, deductions, and tax credits for the current tax year. If approved, the government may adjust or eliminate the OAS recovery tax. In the end, whether you file this form or just wait for the following year's tax return, it's a wash. However, for some of you who prefer to have the funds in their account month to month rather than waiting until the end of the year, there may be some benefit to filing this form early. Alright, so with that out of the way, now let's discuss 10 ways to reduce or eliminate OAS clawback and keep the government out of your pocket. First off is to ensure you're fully utilizing the tax-free savings account. If you have investments that are generating taxable income in a non-registered account, so things like interest income and dividend income, ensuring the TFSA is utilized will help keep the taxable income number down. Second, if the TFSAs are maxed out, pay close attention to your non-registered investments and how the income is distributed. Interest income is fully taxable, so there may be some validity to shifting an investment that generates primarily interest income to an already fully taxable account like an RRSP or a RIF. If your investments produce dividends, you may want to even be a little more careful, as these will also trigger a clawback. This is because dividends are grossed up, and in turn will inflate your taxable income number on line 23400 of your tax return. Now, yes, you will receive a dividend tax credit that will help to reduce your tax bill. However, this does nothing to reduce line 23400 on your tax return, and this represents your income before adjustments like the dividend tax credit. Third tip is to pay close attention to your accrued capital gains, whether it be in a rental property, lake property, significant unrealized capital gains in a non-registered account, etc. There may be some merit to realizing some of these gains before you start your OAS pension. Fourth tip builds on the last. If you do expect to realize some capital gains as you reach age 65, you may want to consider deferring OAS to a later date. Not only will you avoid a potential clawback or loss of the benefit, your benefit will also be permanently increased as the OAS pension is increased, as I discussed earlier, as you delay it. Even if you don't have any significant gains expected, there still may be some validity to deferring this pension till age 70. However, in order to be certain, I would strongly suggest running some scenarios with a professional. The fifth consideration would be to convert an RRSP to a RIF early or simply withdraw taxable income out of these accounts before you start OAS. This may seem counterintuitive, but there are some scenarios where this strategy can make a ton of sense. The sixth consideration is to do the opposite and actually add to your RRSP. If you have the room, it may make sense to add to the RRSP account if you're eligible to help reduce your taxable income and mitigate or eliminate the OAS clawback. This strategy can be especially important for those who are triggering a large one-off taxable event like I previously mentioned. Although the RRSP is fully taxable in the future when withdrawn, if you don't expect your income to be higher in the future and thus don't expect a clawback, offsetting a higher income year with an RRSP contribution can make a ton of sense. The seventh strategy is optimizing your pension income splitting with your spouse. If you have an eligible pension, you can split up to 50% of the income with your spouse to reduce your overall household tax and mitigate or eliminate a potential OAS clawback. The eighth tip builds on the last by using something called CPP pension sharing. To share your CPP pension, you are required to apply with CRA, so it's a bit more involved than simply pension income splitting when filing taxes like the previous tip. There is a specific calculation on the amount you can share, and you need to be eligible. However, with a little bit of legwork here, splitting a CPP pension can go a long way, especially in circumstances where one spouse was primarily caring for the home and does not have some or any CPP pension themselves. Okay, so tip number 9 is to consider using T-series investments, also referred to as return of capital investments in your non-registered accounts. In this type of investment structure, some or all of your investment income distributions are considered return of capital. In other words, it reduces your adjusted cost base. So as an example, if you have invested $100,000 in this kind of investment and it distributed $5,000 a year in return of capital, by year 20, your cost base would be zero, meaning the full amount would be considered taxable as a capital gain. Now, assuming that distributions stay the same, Series T or return of capital investments provide a tax deferral in the early years, but higher tax reporting in later years once the adjusted cost base reaches zero. If you're considering this type of investment, I strongly suggest speaking with a professional. Which leads me to tip number 2. Speak with a professional if you're in doubt on what to do next. Shameless plug, I know, but hey, I help clients with this type of stuff all the time. I understand that it isn't an issue for most retirees as their incomes are below the threshold and easier to manage. However, for our higher income, higher net worth clients, we find there's tremendous value in helping save them from an additional 15% tax. Here's the thing, when it comes to working with a wealth manager like myself, everything is a matter of tax. Just think about it. One of the reasons I like to go through my clients' tax returns is because, well, it's their money. And I need them to understand what's happening with it. And when we start to have the conversation about OAS and an additional 15% tax, you can really start to see the importance of this type of planning. Because at the end of the day, I want to be sure that you are not overpaying the CRA. We look at taxes from a 10-year timeline instead of a 1-year timeline. Because if your household pays, say, $30,000 in tax a year, stacked up over 10 years, that's $300,000 paid to CRA. And over 30 years of retirement, this number really starts to stack up. What I want to see is how we can bring this number down and make it lower. Even if it's only down to, say, $27,000 a year in household tax, that's still $30,000 in savings over the next 10 years. That's why it's essential to be discussing your taxes with your wealth manager and not just your investments. All right, so that does it for today. Let's go through the action items for today's episode. First off is to develop a retirement income roadmap to see how close you are to this OAS clawback. First is to add up your fixed incomes, so things like your defined benefit pensions, CPP, OAS, and other taxable annuities. Then add in other income streams like rental income, investment income from non-registered accounts, and distributions from your RIF or RRSPs. When you start to put the pieces of the puzzle together, are you starting to get close to OAS clawback territory? If so, it's time to go through these tips and see if there's ways to mitigate or eliminate the OAS clawback. Second action item is to share this podcast with a friend or family member who is nearing retirement. Just think, you could be the reason to help someone save a few hundred or even a few $1,000s in unnecessary OAS clawback. I don't know about you, but I think you may earn yourself a free coffee or a free lunch in doing so. Okay, that will do it for today's episode. For all the links and resources discussed, please check out the show notes or visit retiringcanada.ca. If you enjoyed the show, please subscribe and leave us a 5-star review on your favorite podcast app. Be sure to sign up for my weekly Retiring Canada newsletter. And hey, when it comes to your retirement, don't take chances. Make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.